Welcome to Illuminati Silver, where we tell the truth about silver. Today is Friday the 9th of August 2019, and we've been asked by a number of subscribers to talk about those areas where we see of interest to private investors. Whilst most of our members are in fact only interested in gold and silver, or others also have portfolios which include property, shares and government securities. Now, whilst the force of our channel is to confine ourselves to precious metals and those economic and political aspects which affect their demand and price, Inner Sanctum members will now have a section available to them covering interesting areas for potential investment and in some cases divestment. This video, which we are sharing with everyone so that you can gauge the level at which we shall be developing, and for you to determine whether this is worth you joining our Inner Sanctum or not, highlights why the future of coal, as far as private equity is concerned, is severely limited, in spite of a 1.4% increase in global demand in 2018. It points out that renewables are the way forward, including solar power, so interesting for those interested in silver, hydropower, and wind power. It also points out that whether one believes in climate change or not, or in carbon emissions or not, it really doesn't matter, because governments and investors do. And this will dictate the pace at which these sources of energy are mined or developed, which is important to those considering investing in these areas. Today's article is entitled Private Equity Cleans Up, and is written by Christopher Alkan, a financial journalist based in Europe. It's a little technical, with many percentages quoted, but the examples he gives should not be ignored. Let's investigate. Private equity cleans up. Financial journalist Christopher Alkan examines how private equity firms are shifting their energy investments into renewables and shunning the dirtiest fuel. Private equity firms are enjoying a confluence between the forces of economics and ecology in the energy sector. At the same time, as the pressure to go green is intensifying from their investors, funds are finding that the return potential from renewables is especially bright, and the outlook for coal is increasingly gloomy. Quote, "Altruism doesn't pay the bills," unquote, says Liam Smith, investment principal at Actis, a private equity firm focused on sustainable projects in emerging markets. Quote, "But it doesn't matter whether you are terrified by climate change or not. Renewable energy is simply cheaper and less risky," unquote. Many of his peers agree. Judging from the data, last year, private equity general partners who run funds raised a record $41 billion for renewable energy projects, based on data from Preqin. That was almost twice as much as the previous peak of $23 billion in 2015. Funds with a mixed approach, including some share of renewables, raised an additional $23.8 billion. By contrast, funds focused purely on conventional energy sources raised just $12.8 billion, the lowest since 2011, and down from a peak of $45 billion. Within this category, coal, the most carbon-intensive and toxic of the fossil fuels, has become particularly unattractive. This is despite the fact that coal continues to provide 27% of the world's primary energy needs, second only to oil, versus just 4% for renewables, based on data from the energy group BP. It is also, despite falling valuations among public coal companies, causing some investment bankers to promote the industry to their private equity clients as a yield opportunity. That's income generating. Finally, coal has a friend in the United States president, and the US is the world's third largest consumer of coal behind China and India. Donald Trump recently unveiled emissions rules aimed at spurring investment in the sector. So what is driving hard-headed private equity firms away from coal and towards renewables? Even beaten-down valuations for coal companies do not compensate for the risks and weak growth outlook. Smith explains, from a private equity perspective, the first headwind is raising funds for coal projects. As environmental concerns have mounted, coal has fallen out of favour with many potential limited partners, such as pension funds and foundations, and university endowments, who provide the capital for buyouts. Quote, "It is easier to raise cash if you don't have coal, which should in theory lower the cost of capital, all other things being equal," unquote, says Smith. Added to this, private equity firms worry about hidden costs such as environmental cleanup charges and changes in the law, from a carbon tax to more stringent air quality controls, which could erode significant value, says Smith. And then there is the exit risk. The buyer universe for coal companies is shrinking, and many big institutional investors will not hold coal in their portfolios anymore, making a public offering a tough sell. These sustainability headwinds appear only to be increasing. Limited partners are now making ESG, which is environmental, social and governance, more of a focus, according to Johan Dessard, a director at Bain & Company's global private equity practice. In 2017, Japan's government pension investment fund, the world's largest pension fund, with $1.5 trillion in assets under management, required its fund managers to incorporate ESG, which is environmental, social and governance factors, into their decision-making. In the same year, New Zealand's NZ Superfund SWF divested $650 million in fossil fuel investments. Norway's giant pension fund already refuses to own companies that derive more than 30% of their revenues from thermal coal. And tighter restrictions announced in April could force further reductions in coal holdings. Quote, "That increases the risk that investors in coal may end up sitting on stranded assets in a few years," unquote, says Dessard. That weakens the long-run investment case for fossil fuels and explains why some of the world's largest private equity funds are also selling assets that do not meet environmental or social investing guidelines, according to a recent report by Bain on private equity and ESG investing. Bain's 2019 Asia-Pacific Private Equity Survey found that 60% of Asia-Pacic's focused general partners feel increased pressure from their investors to focus more on ESG. Now, while coal investing faces strong headwinds, both in terms of funding and exit risk, the economics behind renewables has been improving. That starts with the cost. Over the past 6 years of available data, the cost of generating solar energy has dropped by 82% per megawatt hour, and that of wind energy by 61%. That is the result of a virtuous cycle of technological progress and economies of scale, says James Mager, responsible investment manager at Actis. As a result, in many parts of the world, the incremental cost of adding renewable energy is now lower than that of adding coal-based energy, even though coal has long held prime position as the cheapest fuel for power plants. Coal-fueled power plants generate 38% of global electricity and renewables 25%, according to the World Coal Association. But renewables are expected to support around 30% of power requirements by 2023, according to the International Energy Agency, with solar and wind power the main drivers of growth. Hydropower will remain the largest single renewable energy source at around 16% of global electricity generation. Many people value having cleaner energy sources and are willing to pay for them. But one of the main drivers of demand for renewable energy is regulatory pressure in both developed and developing nations. The UK government recently became the first G7 nation to commit to reaching zero net carbon emissions by 2050. Poor air quality has turned into public health crisis in Beijing and Delhi, partly due to traffic, but largely because of coal power emissions. Quote, that has made it easier to build momentum for renewables, unquote, says Mego. China was again the largest contributor to renewables growth in 2018, exceeding growth in the entire OECD, according to BP. Quote, in 2017, we have seen a big push by India, Brazil, Mexico, and South Africa, unquote, says Mega. South Africa has not got enough credit for its renewables program. The fact that African nations have been among those suffering most from global warming has intensified their incentive to encourage renewable projects. Some poorer African countries are also supporting solar power generation at local level, rather than setting up a power station grid system. Of the 11 power businesses Actis owns in Asia, Africa and Latin America, 9 out of the 11, are now renewable, and 2 run on natural gas. Natural gas is considered a bridge fuel to renewables, providing a cleaner alternative to coal as a baseload fuel for grids that can be ramped up fast when the sun is not shining and the wind is not blowing. Some natural gas plants can also nearly double output from the same emissions by pushing exhaust heat through a second steam generator, as Actis did with one of its plants in Côte de l'Ivoire. The exit route for such firms is now far more secure than for coal-fired plants. In 2018, for example, Actis sold its Austro Energy renewables business in India to Renew Power, backed by Goldman Sachs and the Canada Pension Plan Investment Board. As that suggests, the larger private equity firms have also been developing a track record for making strong returns on renewables. Blackstone more than doubled its money when it sold its stake in its hydropower venture in Uganda, the Bujugali hydropower project. Although the project has had its detractors, including the nation's president, who has complained about high prices, the venture has generated 45% of the nation's electricity since 2012. Robert Eccles, a visiting professor of management practice at Sayed Business School at the University of Oxford, says private equity firms in the energy sector and other industries have become persuaded that considering sustainability boosts risk-adjusted rates of return. Quote, ecologically destructive firms are simply riskier, and returns are harder to sustain. Private equity firms typically have a relatively long horizon, around 5 to 7 years or more, so it can be hard to make the case for industries that are facing rising public opposition and regulatory pressure, unquote, he says. It can be tempting to write off coal and overestimate the progress made by clean energy. Global demand for coal is still rising at 1.4% in 2018, or twice its average for the past 10 years, based again on BP data. And while renewable energy output rose 14% in 2018, in absolute terms, output of coal still rose faster than renewable. This helps explain why global carbon emissions rose at the fastest pace in 7 years. But for growth-hungry private equity firms, the action now lies elsewhere. So, there we have it. Do you agree with Christopher or not? Indeed, President Trump has put forward his support for coal. But is this enough? Will it just see a short-term upward blip and then a long and slow decline, or even a fast decline? Should someone considering investing in coal think otherwise? Or those already invested consider extricating themselves, and soon? The trends are pretty clear in our view, and as the old saying goes, quote, one should follow the money, unquote. Whatever you decide, at least this presents another perspective or view, and at the end of the day, it is generally true that one can make better decisions the more informed one is. What's your view? Do share. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.